So Facebook's been out trying to make friends on Wall Street, hosting a briefing for 100 or so investment bankers and analysts. Now, obviously, we're all waiting for the IPO in the next couple of months. Everyone's expecting a valuation of about 75 billion, maybe more. So we decided to run the numbers. Richard, you came up with a rather spiffy calculator. Can you talk us through it quickly?
Yeah, well, we got it on the screen here, but the scientific way of valuing companies, or the most scientific way, is always supposed to be discounted cash flow, where you work out 10 years of numbers and some sort of terminal value, discount it, and it's supposed to be more scientific than just a simple multiple, or what often happens in Silicon Valley is some whole new measure or just a whole vision thing that kind of random number. Now, of course, that might be what happens with Facebook. It'll be scarce. It's a big story.
Yeah, they're only
Silicon
selling
Valley.
a small sliver of it,
But
right?
what we thought we could do here is, well, let's try to be scientific. So we talked to a professor at Dartmouth who started comparing Facebook with Google, because it so happens that Google's revenue back in 2004 was about the same as Facebook's last year. So you can kind of say, okay, let's use that as a starting point, lag the Google numbers, see if Facebook follows that, and see what happens to the valuation, see what it might be worth if you do it scientifically.
Right.
So we did that, and assumptions are always the game here, right?
Yep.
So you can twiddle in this model with the margins. The revenue growth is a very crucial one. Margins is somewhat important. Discount rate.
Yep.
Always.
The
big problem with discounted cash flows, which are supposed to be so scientific, is the discount rate, which is a little bit of an art. Is
well, I see you put in
variable.
a 15 percentage point differential in there for people to play with.
So there's a lot for people to play with. You can, if you want to make a valuation of $200 billion for Facebook, you can.
So you can always find a way.
You can always find a way, but what this enables you to do is look at what assumptions you need to get there, which is kind of interesting too. But we put in what we thought were reasonable assumptions. We came out with a number of 75 billion, which is
reasonable assumptions based on 10 years of discounted cash flow.
10 years of cash flow and a terminal value after that. So 75 billion, but an IPO is supposed to leave something on the table for investors.
Right.
So, with these very scarce, popular IPOs, it doesn't always happen, but if the IPO discount is supposed to be 15%, then your number should be somewhere under 65 billion. So
well, that's less than people are expecting. And what do we think about that? I mean, 65 billion for a company that people are talking could be worth 100 billion. How do you think that's going to go down?
It won't be popular among investors, especially ones who've bought the company at very high multiples, because a lot of the shares have been traded recently in the gray market. But again, it's all about assumptions. I mean, you can play the game. It could easily be worth 200 billion. I mean, Google's worth 200 billion. So
do people even care about discounted cash flows on something like Facebook? They're selling a really small sliver of this thing. So what are they going to do? You can buy 5 billion, it shoots up.
Yeah, a lot of this analysis is probably almost post hoc. You decide you want to buy Facebook, and you try to make the numbers to justify to yourself why you think it might be worth it.
But I mean, how many investors actually look 10 years out? I mean, I've seen pitches investment bankers have done where they've said on tech companies, let's go for 3, 4, 5 years out of revenue and EBIT growth.
Right. Well, and
you're looking at 10 years.
I remember back in 99, I saw an analyst report, looked at discounted cash flow, looked at multiples, and then it looked at a number, arrived at completely randomly. It said, we're going to ignore the traditional ones, the DCF, and the other one. We're just going to focus on this one because that's where we think investors are going to go. So that's the reality of these.
Well, if you want to play with the numbers, we've got the calculator on our website. For now, that's it from us. There'll be more from Breakingviews next week.